Burt White. The XLI, which is the select sector spider which tracks industrial stocks, it's only up around 1% year to date versus about 3% for the S&P 500. That's because of a stronger dollar and worries about overall growth, that flat GDP. So why do you like this ETF?
Well, number one, we think that the dollar's going to begin to stabilize here, and I think that's going to take that headwind away. But the big issue is that EM growth is for real, and what we know is that they're beginning to do a lot of infrastructure build, and with that infrastructure build, there's a huge, huge demand for industrials. And then lastly, they're cheap. I mean, they're trading about a 6 times discount to where they normally are at this part of the business cycle. Cheap, and a backdrop looks pretty good for them. We like the sector.
And you also recommend the IBB, which is the iShares Biotech Spider. Now, biotech's been awfully volatile this year because of all that M&A and worries about valuation. Why do you recommend this ETF?
Well, we at LPL Financial Research really love this pick, right? And this is one that's been volatile. It's that M&A is what we really like. Because remember, the healthcare sector has been probably the most consistent sector that we've seen in the market for the last year or so. And what they need is they need growth. And where they're going to get growth is to buy growth. Where they're going to buy it, it's biotech. You got wonderful things that are being developed there. The pipeline looks great. The bionics is what really look excellent there. That's going to revitalize, we think, the industry, and we think that's a great, great buy. Despite stretched valuations, I think it's got a ways to go.
Energy shares got killed over the course of the winter because oil fell. They've been really climbing back. You like the XLE, which is the select sector spider ETF tracking the big energy players. How much higher can this go?
We think it could go a ways. The real key on energy stocks is to buy them when the earnings revision stops going lower. And we're starting to see that now. Earnings revisions are beginning to stabilize. That's great news. But what you want is the big names, the branded franchises, the great balance sheets, the strong balance sheets, because what they can do is not only weather the space, but they can also go in and buy the weaker market participants and pick them up for pennies on the dollar, and they're going to be doing that quite a bit. Look for M&A in the second half.
Well, we can talk about big players, but let's talk about them in tech because you like the Vanguard Information Technology ETF, and this owns a lot of big players, Apple, Microsoft, IBM. Why will the giants of tech really kill it with regard to the market?
What's not to like here? I mean, you got growth. You have lots of cash to do M&A. You're beginning to spin off dividends. You've had a cycle where businesses have underspent. We've been in a confidence recession. And once confidence begins to get back, we've not been able to get our footing. We've had bad weather. We've had port strikes. We've had ISIS and Ebola and all kinds of things that have kept our confidence away. Once confidence comes back, businesses are going to spend money by hiring Americans and upgrading their technology. We think the big winners is big cap tech.
And then finally, you are a fan of the Vanguard Emerging Markets ETF. A lot of people say that when rates rise here in the U.S. and they're going to eventually, it's going to really hit emerging markets. That's typically what happens. So why do you want to be involved with this ETF?
Well, I mean, no doubt about it. The dollar is a headwind, but what really is the key here is to remember the dollar's a symptom. What is the cause? The cause is strong economic growth. Strong economic growth here in the United States is going to spur strong economic growth overseas and in emerging markets. We think emerging markets is poised to do quite well from a growth perspective, and China's for real. China has more stimulus money to spend than anybody else, and we think as they begin to spend more money, emerging markets is going to move and move higher. You're starting to see that now. China's not going to allow their GDP to drop below 7%. They won't allow it, and they have plenty of stimulus money to be able to make sure it doesn't happen.
All right, thanks a lot, Burt.
Thanks for having me.
And thank you for watching The Street.